What you're looking at is the inevitable free market repricing higher after pegging and suppressing the price of premier money, gold bullion, near $35 per troy ounce for some 35 years of time. After the original multinational London gold pool collapsed in 1968, the fiat Federal Reserve note became the anchor to all fiat currencies everywhere only a few years following. Last time London was at the center of politely rigging the gold price, Francis Charles de Gaulle decided to break up the price rigging party. I'll leave a video clip at the end of this week's market update for you to hear from him how the then French president spoke in a similar tone to a modern Vladimir Putin or perhaps a Chinese nationalist might. As you can see on this chart, gold went to work repricing some 24 times higher following the conspiratorial price rigging collapse. For now, let's look at the 24th minute clip in a 30-minute newscast delivered on January 3rd, 1980 in Indianapolis.
The crises in Iran and now Afghanistan are making the world money markets go crazy. A general mistrust of paper currencies is forcing a run on the world's gold supply. 1 ounce of the precious metal was going for $621 at the close of trading in New York today. In London, the price was more than $400 higher than this time a year ago. Zurich's closing price was $118 more than the last day of trading. And in Hong Kong, gold zoomed to a price just short of $650 an ounce. One expert says these prices can only be justified if people have the most incredible fears about world inflation.
As the gold price was nearing full account of the fiat Federal Reserve note debasement at the time, you'll notice that the world had not ended. The financial system was still operating, and while there were real doubts at the time, the fiat petrodollar won over the monetary system again, holding its dominance up till now, another 4 decades of time. All the official gold reserves, allegedly held by the USA in the early 1980s, got revalued so high around that time, we could have theoretically gone back on a gold standard had we so chosen. Shortly, we'll cover a bit on the new forces who have already been gearing up as today's more sophisticated and longer-lasting gold price containment scheme falls apart. For this 2.5 times longer 21st century version, this is roughly where we are in a rhyming comparison today. I'll explain more on that point shortly. Hello, this is James Anderson of SD Bullion, and we're about to go deep to better understand why the LBMA and CME Group are panicking, with new arbitrary rule changes and press releases via Bloomberg and Reuters trying to calm people's nerve and further desire for physical bullion in hand. Before we dig further into some 21st century gold conspiracy facts and figures, let's look at some of the week's unprecedented and rather depressing data, much of which is attributable to the private Federal Reserve and their dual mandate failure in motion. The Federal Reserve's balance sheet, after slightly rising for months following the middle September 2019 repo loan ramp, has now gone exponential. We are now on pace to see a doubling of their balance sheet by the 4th of July 2020. Yeah, you heard that right. At this pace, in just over 3 months from now, the Federal Reserve could have more than a $10 trillion balance sheet, mostly bought with fiat digits punched up on a keyboard. These are but a few of the many monetary and fiscal policies which will partially contribute to the Federal Reserve's balance sheet more than doubling sooner rather than later. Oh, and one final note on this chart. The last time the private Federal Reserve tripled its balance sheet was following a massive and similar deleveraging event in late 2008. Here is how the 4 major precious metals responded. Unemployment filings got about 100% worse than last week's unbelievable amount. 10 million American workers are officially out of work over the past 2 weeks of time. To put that number into context, that's basically a little bit more than the entire working state of Florida out of work. The silver mining industry has more than half its output currently shut down, and this past week both the largest silver-producing nations of Mexico and Peru have effectively closed down their major mining sites. This news and reality like this, from shut down mines, refiners, and mints, it all just further energizes heavy silver demand and thus waning silver bullion shortage constraints. as spot versus bullion prices diverge further. This week, both the LBMA and CME Group, they've been out on a public relations red alert. The COMEX Gold Futures Derivative Contract Exchange, which mostly influences the disconnected gold spot price determination mechanism, they're doing their best to calm concerns over their exchange, perhaps not having enough gold bullion fractionally reserved, ready for physical delivery and potential contract settlements. Never have we ever seen such a dramatic shift between the undeliverable eligible pile to the now deliverable registered pile. One's left to wonder if we're about to see record-breaking stand for delivery session on this limited gold that backs that highly leveraged derivative exchange. For perspective on physical gold, this entire pile represents but one of 590 physical gold ounces above ground on Earth. The LBMA was out again this week, smelling of desperation as they effectively used Reuters as their press release platform. Essentially, the LBMA cited that they oversee at the moment a bit more gold bullion than the unaudited U.S. official gold reserve tonnage total. What they failed to mention, and what Reuters would never bother to ask or report on, is that of the over 8,300 tons the LBMA claims to oversee, what amount is actually deliverable gold float supply and not owned by sovereign nations or gold exchange traded funds. It so happens data wrangler Nick Lard from goldchartsrus.com has the data updated at the end of 2019 for London gold holdings. Only about 1 for every 200 tons of gold bullion in the world is floating in that supposed transparent system at the moment. So while the CME Group's COMEX and LBMA's London Gold Trading Hub may at the moment still have sway on their underperforming spot and over-the-counter prices for gold, the physical gold bullion trading world has now moved further away from their bid-ask influence and is again outperforming their derivative price discovery proxies, as we witnessed in the fall of 2008. Of course, it remains to be seen how long this current dislocated gold price discovery system can continue without further dislocations. The smart money has or is likely going for the physical bullion, at least the physical bullion that they can manage to attain at the moment. And now to finish this week's market update, I want to tie up how we began this update, investigating the last Western world-driven bullion bull market, which effectively kicked off in 1968 with the collapse of the London gold price rigging pool. A dozen or so years later, by early 1980, all 4 major precious metals nominally fiat currency price highed within weeks of one another. A couple of years ago, the chart that you're looking at now, it literally took my breath away once I understood the implications the compounding price data trends were making. Over the years, I've shared this chart many times. Some people get it. Most may not understand what it's conveying, and a small number actually have attempted to explain it away, citing Eastern gold jewelry price hedging as the reason for the divergence. Perhaps I'll tackle that point in a minute. But first, let's focus in at the start of this chart in 1970. We begin with a gold base price starting at $35.12.5 per troy ounce, as that was what gold was priced to begin January 1970. The red line is this entire chart conveys the LBMA AM gold fixed price ongoing. It is fractionally close to the gold spot price, thus you can simply think of the red line as the gold spot price. The blue line represents compounding gold price data covering the Eastern world's gold trading hours. Had you simply bought the LBMA PM gold fix, held it overnight, and then sold on the LBMA AM gold fix the next trading day, that is what that line is effectively showing. We can think of the blue line as the Eastern gold price compounding for 50 years. The black line is the theoretical price had you always bought the LBMA AM gold fixed price and then sold on the LBMA PM gold fixed price, basically a 4.5 hour holding period on daily trading. We'll refer to this black line as the London price. Just over 2 months ago, in a video we released on this SD Bullion channel entitled Yet Another CFTC Position Limit Fail, one which the algorithm content police did not like, we went through a verifiable gold conspiracy fact regarding the very founding of the COMEX Gold Futures Exchange and the U.S. Treasury cables intercepted by WikiLeaks, which document notes from meetings in London between U.S. Treasury agents and major London gold price fixing parties at the time. The document proves that the U.S. Treasury was worried about the escalating gold price, which was nearing $200 an ounce in late 1974, and that the re-legalization of private gold bullion ownership for U.S. citizens in 1975 would become an issue, essentially a competitor with the then inflating full fiat Federal Reserve note. The London gold dealer suggested that the COMEX be so highly leveraged to induce high price volatility into the gold futures contract price discovery mechanism. By doing so, it would deter scared investors from saving gold bullion en masse. In 1975, look right where the L in London is located. You can see the London AM to PM fix agents did their part by no longer allowing their gold price fixes to have gold prices rising on a regular basis. More so, they went sideways to dampen the daily price fix and even downward toward the mania phase of the late 1970s, early 1980s gold bullion bull market. And while the price volatility injecting COMEX likely too helped to essentially cut the price of gold in half from $200 to around $100 an ounce, some 18 months after 1975, the gold price then re-ramped more than eightfold from $100 to over $800 an ounce as COMEX lost control of the bulls and the derivative betting longs. China, Russia, Turkey, even India, none of them were sitting in COMEX gold pits, driving the last gold bullion bull market. It was more so a Western derivative-driven affair. Now we're going to move forward in time to focus in on the 1980s. The LBMA came into existence in 1987, established by none other than the Bank of England, the world's oldest still running central bank. By the middle 1980s, we can see here how the blue Eastern-driven gold price dislocates from the red Western AM fix and begins outperforming the other two lines during the late 1980s and 1990s gold bear market. Then, in the year 2000 and the 21st century gold bull market as it begins, the price divergences between the three lines blows out in epic fashion. Based on this over 50 years of compounding gold price data, beginning at just over $35 an ounce in 1970, the last London AM price fix on the chart was at $1,594 an ounce. The Eastern-driven 50-year price for gold is at $18,572 an ounce, denominated in fiat Fed notes. And the London intraday AM buy to PM sell gold fixed price data has the price of gold at $2.98 per troy ounce in early April 2020. If someone out there knows Ruth Crowell, the CEO of the LBMA, please send her this video. I would love an explanation for how in the hell that divergence has occurred. Oh wait, I was once told it was Indian gold jewelry price hedging. That's got to be what it was. Here is the same 50-year gold price compounding data phenomenon expressed in other non-logarithmic isolated gold price chart formats. Swinging back to the full 50-year logarithmic version of this chart, and now the CME Group, COMEX, and LBMA effectively have merged public relation campaign of late, it's hard not to inject other nefarious documented facts upon this chart that coincide with the stretch the cyclical bear market occurred within the secular 21st century bull market. You see, the central bank incentive program has been public record since the year 2013 and has been extended and corresponded to the CFTC2 through the end of January 2021 minimum. Allow me to read my own tweet on the matter so you might grasp the significance and potential ramifications of such a program ongoing. 2013-2021 Central Bank Incentive Program promoted by Working Group on Financial Market Member, CME Group, essentially allows accepted foreign central banks to trade via proxy desk, any PM, or commodity or FX derivative. Think about potential full spectrum ramifications over that time frame. The final point about how this current gold price discovery mechanism and gold market does not function well at all and inevitably has found itself in dislocations and shortages of late. Same goes for NYMEX palladium, COMEX silver, and other derivatives and commodities that are traded with way too much speculative leverage. In late 2015, one of the heads of the currently shut down major Swiss gold refineries had the following to say about the seemingly endless Chinese gold kilo demand at the time, just before the fiat Fed note gold price bottomed near $1,050 per troy ounce. Here's what he thought of the building derivative versus physical bullion situation back then.
So there's a paradox here, isn't there? Because, the price is sort of perceived generally as the price of gold on the spot market is seen as low. What's your understanding of the current price of gold? How well does price today reflect the realities of physical supply and demand that you've just described?
Not at all. Don't forget, we have a huge amount of artificial gold or paper gold or however you would call it, floating around the markets. It is sometimes you can just see the figures if you look at the numbers of futures exchanges, and a lot of metal you can't even detect because it is somehow within some derivative product, which at the end you have no clue how much it is and on which side it is. And the other thing is also nobody is interested in any physical delivery at the end. These products, they are all cash settled, and people are happy, just to use the spot market as a benchmark. And the product itself never ends up in physical market. This, of course, to me, looks dangerous. If we once will have the situation that people say, no, okay, now I have a long position that expires, I want the physical. If everybody would do this, for sure, the physical is not around.
But that's a big if, of course. Is it your belief that this sort of paper market can be sustained indefinitely with a huge mismatch between the price in the market and the supply and demand in the physical? Can this go on forever, or will it break at some point, do you think?
Yeah, you see, that depends very much on the behavior of the market participants. Generally, if you look at the situation all over generally that we have now, nobody will understand the price of gold. Now we have serious geopolitical, not only risks, but already issues. We have a financial world with all the debt crises that we have never seen for decades. And yes, we have a relatively low gold price that is in no correlation with the physical market. So question mark after question mark. Will this continue? I think it depends very much on the behavior of the people. As long as the market participants are happy for cash settlements, this can go on forever. Then spot market price of gold is nothing more than a number, nothing more than a benchmark. People are happy, cash settlement, so they take the currency. If this behavior should change, yes, then I don't know. Then it could become dramatically dangerous.
That clip was provided by Alex Stanczyk's Physical Gold Fund, who, by the way, only a week ago today had an incredible interview with Jim Rickards on their series called The Gold Chronicles regarding many of the topics we cover here. When you have an hour of time, go check their discussion out here on YouTube. Finally, stay tuned to the end of this video and watch the 2-minute clip on how the London gold pool price rigging scam came to a quickening end. And then think in terms of the Eastern de-dollarizers out there. How might they put an end to this current second iteration, the Western LBMA and CME Group gold price derivative discovery pool ongoing? That's it for this week. Take good care out there. If you enjoyed this content, be sure to give our video a thumbs up. If you're not subscribed to our channel, do that. And finally, be sure to hit the alert button so you don't miss these market updates as they come along. Give us your comments below. Let us know what topics you want to see more coverage on.